Welcome to this chapter. Now, we will dive into Japanese candlesticks. What is a Japanese candlestick? In this chapter, we will explore about Japanese candlesticks in Forex trading. Here's what you're going to learn. Japanese candlestick anatomy. Basic Japanese candlestick patterns. Single candlestick patterns. Dual candlestick patterns. Triple candlestick patterns. Candlesticks with support and resistance. Japanese candlesticks in Forex trading are used to describe currency price action and can be used for any time frame. Steve Nissan, a Westerner, learned about Japanese candlesticks from a Japanese broker. He dedicated himself to studying and writing about it, which led to its growing popularity in the 90s. Without Nissan, candlestick charts might have remained an unknown technique. Japanese candlesticks can represent any time frame and show price action using the open, high, low, and close of that period. The body represents the price range between open and close, while the shadows show the high and low points. The top of the upper shadow is the high, and the bottom of the lower shadow is the low. Just like humans, candlesticks have different body sizes. As Forex traders, it's important to take note of what type of body a candlestick takes. Long bodies show strong buying or selling pressure, indicating buyers or sellers were in control. Short bodies suggest minimal market activity. In Forex, bulls represent buyers, and bears represent sellers. Long white candlesticks indicate strong buying pressure, showing a significant price rise from open to close. Long black candlesticks signal strong selling pressure, reflecting a major price drop from open to close. A long upper shadow with a short lower shadow shows that buyers pushed prices up, but sellers brought them back down near the opening price. A long lower shadow with a short upper shadow indicates that sellers pushed prices lower, but buyers drove them back up near the opening price. What do spinning tops, marubozus, and dojis have in common? They're all the basic types of candlesticks. Spinning tops are Japanese candlesticks with long upper and lower shadows and small bodies, signaling market indecision. The small body shows minimal change from open to close, while the long shadows indicate both buyers and sellers were active, but neither gained control. Despite little overall price change, there was significant movement during the session. A marubozu candlestick has no shadows, indicating full control by either buyers or sellers. White marubozu. Bullish, showing buyers dominated the entire session. It often signals a bullish continuation or reversal. Black marubozu. Bearish, indicating sellers controlled the session. It usually suggests bearish continuation or reversal. Doji candlesticks have the same or nearly the same open and close price, forming a small body that looks like a thin line. They indicate indecision between buyers and sellers, with neither side gaining control. There are 4 types of doji, and their appearance can vary, resembling a cross, inverted cross, or plus sign. A doji after long hollow bodies signals buyer exhaustion, indicating a potential price drop as sellers step in. Conversely, a doji after long filled bodies signals seller exhaustion, suggesting buyers may drive prices back up. What is the difference between a hammer and a hanging man? Time to start learning about your basic candlestick patterns. The hammer and hanging man look exactly alike but have totally different meanings depending on past price action. Both have cute little bodies, black or white, long lower shadows, and short or absent upper shadows. The hammer is a bullish reversal pattern that appears in a downtrend, signaling a potential price rise. Its long lower shadow shows that sellers pushed prices down, but buyers regained control, closing near the open. Confirmation often comes when a white candlestick closes above the open after the hammer. A hammer has a long lower shadow, 2 to 3 times the size of the real body, little or no upper shadow, and the real body is positioned at the lower end of the range. The body's color doesn't matter. The hanging man is a bearish reversal pattern that signals a potential top or resistance level. It forms when sellers start to outnumber buyers during a price rise. The long lower shadow shows sellers pushed prices down, but buyers could only bring it back near the open, indicating weakened buying momentum. A long lower shadow, about 2 to 3 times the real body, with little or no upper shadow. The real body is at the upper end of the trading range, and while the color isn't crucial, a black body is more bearish than a white one. Inverted hammer and shooting star are similar in appearance, with the key difference being their position in a trend. An inverted hammer signals a bullish reversal in a downtrend. A shooting star indicates a bearish reversal in an uptrend. Both have small bodies, long upper shadows, and short lower shadows. The inverted hammer forms after a price decline, hinting at a potential reversal. Its long upper shadow shows buyers tried pushing prices higher, but sellers resisted. Despite this, buyers managed to close near the open, suggesting that most sellers have already exited. The shooting star is a bearish reversal pattern seen after a price rise. It shows the price opened low, rallied, but fell back. Buyers tried pushing it up, but sellers took control, signaling that the buying momentum has ended. They say that trouble comes in twos. Let's find out how dual candlestick patterns may not necessarily spell double trouble for your account. Engulfing candles occur when a smaller candle is followed by a larger one. A bullish engulfing pattern happens when a bearish candle is followed by a larger bullish candle, signaling potential upward movement. A bearish engulfing pattern is the reverse, where a bullish candle is followed by a larger bearish candle, indicating potential downward momentum. Tweezer bottoms and tops consist of 2 candles. The first candle follows the current trend, bullish in an uptrend, while the second candle moves against it, bearish in an uptrend. Both candlesticks have shadows of equal length, signaling potential reversal. What's better than dual candlestick patterns? Triple candlestick patterns. Triple Japanese candlestick patterns consist of 3 candlesticks and help traders predict future price movements. Some indicate trend reversals, signaling the end of a current trend and the start of a new one, while others show trend continuations, suggesting a brief pause before the trend resumes. Evening and morning stars are triple candlestick patterns that signal potential trend reversals, typically occurring at the end of an existing trend. Evening star pattern. First candle, a bullish candle, part of a recent uptrend. Second candle, a small-bodied candle, bullish or bearish, indicating market indecision. Third candle, confirms the reversal, closing beyond the midpoint of the first candle. The morning star is the inverse, occurring at the bottom of a downtrend, and includes the same characteristics, but in reverse order. First candle, a bearish candle at the end of a downtrend. Second candle, a small-bodied candle, bullish or bearish, indicating indecision. Third candle, confirms the reversal, closing above the midpoint of the first candle. Both patterns highlight a shift in market sentiment, suggesting potential changes in trend direction. The 3 white soldiers pattern marks the end of a downtrend or consolidation phase. The first candlestick signals the reversal. The second candlestick should be larger than the first, closing near its high with little to no upper wick. The third candlestick should be the same size or larger than the second, also with a small or no shadow, confirming the pattern. 3 black crows is a candlestick pattern signaling a potential reversal after a strong uptrend. It consists of 3 bearish candles following the uptrend. The second candle's body should be larger than the first and close near its low. The third candle should be equal to or larger than the second, with a very short or non-existent lower shadow. 3 inside up is a bullish reversal candlestick pattern occurring at the end of a downtrend. The first candle is a long bearish candlestick located at the bottom of the downtrend. The second candle should rise to at least the midpoint of the first candle. The third candle must close above the high of the first candle, confirming that buyers have gained control over the downtrend. 3 inside up is a candlestick pattern that signals a potential trend reversal at the bottom of a downtrend. This formation suggests that the downtrend may be ending and a new uptrend is beginning. The first candle is a long bearish candlestick located at the bottom of the downtrend. The second candle rises to at least the midpoint of the first candle. The third candle must close above the high of the first candle, confirming that buyers have gained strength over the downtrend. 3 inside down is a candlestick pattern that indicates a potential trend reversal at the top of an uptrend. This formation suggests that the uptrend may be ending and a new downtrend is beginning. The first candle is a long, bullish candlestick located at the top of the uptrend. The second candle should decline to at least the midpoint of the first candle. The third candle must close below the low of the first candle, confirming that sellers have gained strength over the uptrend. This section highlights using candlestick patterns alongside support and resistance to guide trading decisions. Patterns alone are not enough. Broader market context and price movements are essential. Although they can suggest reversals or continuations, these signals are not guaranteed and must be evaluated within the market landscape. The simplest way to utilize candlesticks is by analyzing their interaction with support and resistance levels. These levels indicate where buyers and sellers have established defenses, and observing how candlesticks react to them can significantly aid in predicting future price movements. In this scenario, you can see that there is resistance around the 1.4900 level. You badly want to enter, but you decide to wait instead because the candle that touched this level looks very bullish. 2 candles later, you spot a nice 3 inside down candlestick pattern, which is considered as a very potent bearish signal. Using the formation as your sell signal confirmation, you go ahead and short the pair. Since you're a smart trader, you also set a stop loss above the resistance. We've taken the liberty of highlighting some potential trade signals based solely on candlestick formations. If you had traded on those candlesticks formations alone, you would have lost every single time. By simply pairing candlestick formations with support and resistance levels, you have increased your odds you're winning. And that wraps up this chapter. We've gone over the essential concepts that will help you navigate the Forex market, providing you with a solid base to grow your trading knowledge. Thanks for joining me, and I'll see you in the next chapter.